Antonio. Welcome back. You may have noticed by now how all the sessions on the agenda we have prepared for you this year are linked. Mauro Guillen discusses 2030 demographics is linked with Robert Posen and the future of work. The second session, in which Kay Marvel discusses climate change, links to my conversation right now with Marco Papic about the race to zero and its geopolitical implication. The session with Cam Harvey on Web 3.0 or DeFi or decentralized finance, which has already received over 120K views on social media, is closely related to this session, in which we will explore the future of money in depth. We are delighted to have long-term collaborators with our events and institutions on board for this. Let me begin with the first, Jose Manuel Marquez, head of the Bank of Spain Financial Innovation Division, who is directly involved in projects about system design and Cbdc interoperability. Thank you very much, Jose Manuel. Our virtual stage is all yours.
Thanks a lot, Antonio. Thanks a lot, Iker, for organizing this wonderful conference. Today, I had the pleasure to talk with Professor Eswar Prasad. Eswar is the Tolani Senior Professor of Trade Policy at Cornell University. He's also Senior Fellow at the Brookings Institution, where he holds the New Century Chair in International Economics and Research Associate at the MBA. He was previously Chief of the Financial Studies Division in the IMF, and also head of the IMF in China, in the China division. On top of that, he has written several top journals, including one paper some years ago for the FLAR about the Cbdc on Latin America. And he recently published a must-read book. It's a fascinating book that covers many aspects of what is happening in financial innovation and the financial system, with a title with the future of money. Eswar, thanks to be here and thanks for the opportunity to talk with you. Eswar, in your book, you revise in a very periodical way. It's clear your passion for teaching a broad set of issues, including fintech, insurtech, cryptocurrencies, CBDC, the role of central banks, or even the change in the international monetary system. I think it will be impossible to cover all these things. Then in less than 1 hour, then I would like to focus mainly on crypto and on the CBDC. But before that, I would like to enter in some broad question. Innovation for financial system, as you mentioned in your book, is not something completely new. That is, we have several innovations in the history. We have the deposit insurance, the credit card, the ATM, the risk models, the online banks. But there has been a set of several innovations in the financial system. Then the classical question is why this time is different. Paraphrasing Reinhard Rogoff, why we should think that now we are facing a different change, a different innovation for financial system.
So thank you, Jose Manuel, for that question and for introducing me. And I'm also very grateful to FLAR for allowing me to participate in this conference. And the FLAR annual conferences are always one of the highlights of the policy conference calendar, given the range of issues that are discussed and the quality of the participants. As you correctly point out, Jose Manuel, financial innovation is nothing new. And while the term fintech, which is supposed to encapsulate this notion of new financial technologies, suggests that something has really changed this time, it's worth thinking about what is really different this time. In my view, there is one important difference, which is that we now have the ability to create transformational change in many aspects of financial markets and institutions, thanks largely to a set of new technologies that have put the power of these technologies at the hands of consumers and businesses in a way that they have not been able to access them before. And of course, even before one talks about cryptocurrencies and blockchain technology, there is the sense that mobile technologies really have made a big difference in the ability not only to create innovations that can reach even the common man very easily, but to allow them to be scaled up to a level whereby they can provide very broad access to even basic banking products and services, irrespective of whether you're talking about a developing economy context or an advanced economy context, and in a way that more directly conducts financial intermediation operations, say connecting savers and borrowers directly through fintech lending platforms, providing easy access to low-cost digital payments, which until now was reserved for the relatively well-off and largely limited to advanced economies. This brings up another important issue about the new financial innovations, which is that emerging markets do seem to be leapfrogging advanced economies to a significant extent. And part of the reason for that is related to the scalability of these technologies, but also the fact that you have a rising middle class in these economies that wants better products and services, and the fact that you had a regulatory void that allowed these new products and services to be brought up. So I think we're really at the cusp of something quite transformational right now.
That is right. I think that this connects very clearly with the last session that we have about the geopolitics and the emerging of the middle class and the Latin American and all these opportunities. Let apart this change in the international financial system and the roles of emerging for later and entering a bit on the discussion about crypto assets or crypto tokens or cryptocurrencies. You mentioned in your book that paradoxically that Bitcoin and was really a smart idea. You explain very clearly the nice and the wonderful proposition of Bitcoin and how it solved this reliance on third parties. However, even that is a smart idea, clearly failed and did not succeed as a means of payment. Let apart what happened in El Salvador. But instead is gaining support as an investment or a store of value. And this is basically, as you clearly point out, that because of the scarcity of the issuance of Bitcoin and the demands from the people of this asset. Let's begin with this one. Could we consider crypto asset like Bitcoin or Ethereum, not including the stable coin, that is something different, as a traditional investment asset, that is something with maybe not an intrinsic value, but high volatility? But there is something different, especially in crypto, in this Bitcoin or Ethereum, that we should take into account from an investor perspective. And please take into account that most of our audience are reserve managers from central bank, and I think that they are really interested in your asset.
Yeah, that is a very profound question that becomes especially important when you're thinking about a market that now has a capitalization approaching $3 trillion by some measures. It is paradoxical, as you've pointed out, Jose Manuel, that what was meant to be a pseudonymous medium of exchange that did not require a trusted third party such as the central bank or a financial institution has become a speculative financial asset. So as an economist, I think the question to ask is, what is the demand for this asset coming from? Is it providing any intrinsic service? Does it have any intrinsic value? And the answer to that seems to be no, because Bitcoin has failed in the fundamental objective for which it was set up. So then one can think about what the alternative sources of value might be. And again, as you pointed out, the notion that there will be only 21 million Bitcoins ever created, of which about 18.5 million have been created so far, is the fundamental value proposition. But as an economist, this seems like a very dubious value proposition, that something that is scarce simply because of its scarcity is going to have value. Now, certainly one can make the point that the same seems to hold true for gold, which has at least some basic intrinsic uses, but certainly has a market value that is far out of line with its intrinsic value. And it's often spoken about that Bitcoin can serve as an inflation hedge and is a better source of value in terms of the long term compared to something like a fiat currency that can be issued at will by central banks. But in my book, I lay out this proposition that, in fact, what makes central bank money a much more viable long-term store of value is not that it is restricted in supply, but precisely because it can be supplied elastically, that is essentially in infinite quantities. Because if you think about what modern financial systems need, they need liquidity. And often they need very large infusions of liquidity in order to be able to sustain themselves through periods that are very difficult in financial terms. And what the major central bank currencies offer, of course, is precisely that, the ability to be provided in very large quantities when you have substantial demand for liquidity. So again, perhaps one might think about this as paradoxical, but it is the very elasticity of supply in the major fiat currencies that preserves their stores as their roles as stores of value. So ultimately, as I look at this over the longer term, it's difficult for me to envision Bitcoin. Once you set aside the very cool technology, and the technology, as you've noted, is certainly very cool, and the fact of scarcity, it's difficult to see where exactly the value comes from, except, of course, investors' faith. When you have a large enough community of retail investors and potentially wholesale investors as well, who are willing to put their faith behind this scarce commodity, maybe it has value. But I worry about whether this is going to be value that is a sustained proposition over the long run, especially relative to the traditional store of value, which is fiat currencies.
Yeah, it's something logical. That it is, you think Bitcoin has been designed as a means of payments, and basically maybe this lack of supply is because it's designed as a means of payment, but now suddenly it's a store of values. And some research analysis with some econometrician models that we performed, the Bank of Spain, point out that the fundamentals what explain the price of Bitcoin, it's constantly changing around time. Then it's something very unstable from an investor perspective to know how to invest or how should this change. Then I agree with your concern that this is very, very unstable what is happening with Bitcoin, and it's only the faith of people that basically explain the price. But let me jump to another issue. That is, I usually talk with many people from the crypto space. I have to manage the sandbox and this kind of discussion with innovators. And usually the people from the crypto space claim, okay, I would love to be regulated. I would love some kind of regulation. I think that very soon we are going to see if this is real or not, because as you know, in Europe, we are close to finalizing regulation on crypto, on service providers on crypto assets and on some of the issues. And there has been some rules from the FSB also regarding the crypto space. But even though we have some regulation, there are some aspects, and Bitcoin is one example, that are based on a purely decentralized mode, or some innovation, like, for example, DeFi, that is very difficult to regulate. Then my concern is, could we enter in a space where we could have a clearly regulated financial system, a clearly less regulated financial system, like the Wild West financial system? Should this be a concern to have these separated worlds? How we can manage this situation? We should deal with more education, with more discussion about what will imply to be regulated, what will imply not to be regulated, or the approach should be like China, of prohibition on these kind of things that are impossible to regulate, or some kind of standardization like India. What is your opinion on this situation?
That is a very profound question, Jose Manuel, and one that national regulators in every country are going to have to deal with, because, Bitcoin and many of the financial products spawned under the label of DeFi know no borders. You can even think about payment systems, both at the retail and international levels, essentially being intermediated through some of these platforms. So you certainly need regulation. But at the same time, the question is how one can make sure that one can benefit from the potential innovations that can be had from democratizing finance and making a broad range of products and services more easily accessible to a large part of the population without killing off the innovation. At the outset, I would note one irony, which is, as you correctly pointed out, Jose Manuel, the cryptocurrency industry does seem to be welcoming regulation, but up to a point. I think the fact that you have the government providing some degree of regulation actually legitimizes the industry, and the industry certainly benefits a great deal from the perception that they are, so to speak, officially approved, even though that's not quite the intent of the regulators. Of course, once the regulations actually start taking firm shape, you will no doubt hear a lot of squealing from the cryptocurrency industry that the government is trying to block innovation. So that is coming. But I think the risks are real. And from a regulatory point of view, I think both the institution or product-specific risks and the systemic risks will need to be carefully thought through. At the moment, if you think about the capitalization of the cryptocurrency market, which is in the range of $2.5 to $3 trillion, depending on which minute you happen to look at the data, the reality is that you don't have that much exposure of the major financial institutions, as so far as most of us are aware, that could cause a huge amount of spillovers to the broader financial system. But certainly there are lots of naive retail investors who are joining the party quite late, as I see it. So issues of digital access, financial literacy are certainly going to be important ones. In the specific context of DeFi, of course, there is a notion that you can actually use computer tools to test the security of these products and also about the financial risks associated with these products. There is the notion that you can use permissionless composability to plug in not just different modules to create new financial products, but also plug in regulatory and compliance tools. But I think there are some other risks out there. I had an op-ed in the Financial Times just a couple of weeks ago pointing out that there are new and potentially unforeseen risks that are coming. As you plug together multiple products, then you end up with a situation where you increase the attack surface. And while the blockchain is certainly very secure and provides a great deal of resiliency, there is a real concern that you could have sophisticated hackers basically exploiting loopholes, especially as you plug together a variety of products. There are, of course, technological vulnerabilities out there, but even the decentralized nature of the governance, I think, creates some risks. Now, the notion of not having governance centralized in an institution or the government is certainly a very attractive proposition. But some of my colleagues at Cornell did this very interesting study where they found that there was a possibility of front-running a particular product, a particular DeFi product. Now, they had nobody to report this to, so they wrote a blog post pointing out this potential vulnerability. And what happened before the community could fix the open source code to fix this problem, a whole cottage industry of bots emerged in order to exploit this precise vulnerability. So I think while the notion of decentralized governance, decentralized architectures are very attractive, we're going to have to be very cautious about the risks that may emanate that are new. So ultimately, governments are going to have to play a big role here. Even when you think about something like stable coins, which are supposed to be relatively safe because after all, in principle, they are backed up by reserves of hard currencies and reserves of liquid instruments in those hard currencies. There is a concern, and there is a lot of discussion here in Washington about this right now, that these may end up becoming exactly like money market mutual funds, which were supposed to be very safe investments, but in the lead up to the global financial crisis, turned out to have a variety of problems because the markets for the assets that they held turned out not to be as liquid as we thought they were. So we might end up in a situation where you essentially have stable coins becoming like unregulated money market mutual funds. But at the same time, stable coins are trying to meet a real need for easy access to low-cost digital payments. So I think governments are going to have to find a balance here. I think banning cryptocurrencies altogether, like China has done, may not be the right answer. Perhaps the India approach of providing a payments infrastructure on top of which the private sector can innovate and build new products, that might be the enlightened and right way to go.
Very interesting that your answer touched many aspects. That is, I will take several issues like the regulators should adapt to this new technological system and engage also and take into account that this can be useful to impose some of the compliance, but at the same time, be aware of this new financial instability, new financial vulnerability that came from these decentralized instruments and these new technologies, and maybe the too big to fail or the systematic failures for the systems could be others, and then we should also invest in cybersecurity and all these kind of issues. And let me jump to this debate that you open now with stablecoin. I agree with you that there is a big concern, and you know that in Europe we are also close to develop some kind of regulation, and we have an intense discussion about how to regulate and what should be the regime for stable coins. And I know that in the United States, in US, you have you have some proposals, for example, from USD Coin that recently announced the intention to ask for a full reserve bank license. Something that remind me that is very close to the concept, to the traditional concept of narrow banking. But my question will focus on the last part of your answer. They are covering some business area or some aspect that clearly has some sense. Then, what do you think is the main value added from this stable coins proposal? Why these companies proposing some stable coin will like to enter? Because here the proposal is more related with payment system and not with investment side. Why they will like to enter in the case of developed countries, in the case of an already very crowded space like the payment system? What are they adding to the system?
That's a good question, and it is very country specific. If you think about a country like Sweden, there is no user case for a stable coin because the private sector is providing very widely accessible, very low cost and efficient digital payments. And a stable coin probably wouldn't get traction. If you take an economy like the US or even Canada, for instance, you have the existing payment providers, including credit card companies, still having a very strong foothold in these economies. You know, I can use Apple Pay on my phone, but I have to connect it to a credit card or a bank account. And the reality is that in the US, about 5% of the adult population is still unbanked or underbanked. If we look at the availability of credit cards, it is quite limited. The same is true of Latin America. I did some work with Flour, pointing out that in many countries in Latin America, the adoption of digital payments is again quite limited. Of course, people prefer cash, perhaps because it allows them to avoid taxes and you have a large informal economy, but you also don't have easy access to digital payments. So stable coins, in terms of retail payments that are easily usable by both consumers and businesses, might really have a user case going for them. The same is true of international payments, which are particularly beset by lots of inefficiencies in terms of cost, the time to process payments, the time it takes for finality of settlement, the fact that you cannot easily track payments in real time. Given the technologies that are available to us these days, it is astonishing that we don't have better payment systems. So I think stable coins can certainly give us more effective ways of using even retail central bank money and perhaps also get around some of these inefficiencies at the international level. So in the US, I think there is potentially a case to be made, but I think one can ask as a government whether you really need stable coins to be able to accomplish all of this. The US has an initiative being undertaken by the Fed and other government agencies to improve both the retail and wholesale payment systems. Although, if you look at some of those proposals, it looks like the US is trying to get in the next 3 to 5 years to where China was a few years ago. So some advanced countries, some developing economies are certainly far behind. And in those countries, maybe stable coins can play a useful role. But there are some significant concerns here. I mean, stablecoin issuers, including Facebook, which of course is now called Meta, when it talks about its proposed stablecoin Diem, talks about it not trying to run monetary policy in any way, because after all, every unit of Diem will be backed up by reserves of whatever hard currencies it is issued against. But given the very widespread reach of Facebook, given the enormous financial clout it has, it's not inconceivable that one day Facebook, once its stablecoin is widely accepted around the world and particularly in developing countries, decides to start creating money of its own without backing by fiat currencies. So I think regulators also need to think a little bit about what sort of foundation might be created for private corporations beginning to issue their own monies in competition with central bank monies.
Yeah, let me develop more on this discussion, because I think that next years, I think that the next 2 years, in some way, we are going to have at least the basic rules or the basic regulation for stable coins. That is, I think that Facebook has been very clever in order to promote it, that all the regulators are discussing how to regulate this new product. And in a record of time, we are going to have some kind of regulation. Then once that we have some kind of regulation for stable coins, things could dramatically change, as you basically pointed out. Then I think that we have, from my perspective, we have two concerns. One concern is the one that you mentioned, that given the network effect that they will have some monopoly power in the payment system, or even in the issuance of money in some developing countries. And in some sense, we have the experience of China, where basically two big tech companies have the monopoly of the payment system, and this explains the reversion from the People's Bank of China with the Cbdc. And the other concern is the opposite situation, where you will have several payment systems that could not be completely interoperable, and that maybe you will have a very fragmented payment system. That is something not necessarily very good for the financial system. Then how do you see these two concerns? Because it's really difficult to avoid these two extreme situations.
You're right, Jose Manuel. I think you've pointed to some difficult tensions that regulators will have to face. Now, again, as economists, we are all for competition. I think the idea of letting 1,000 flowers bloom, having multiple payment providers compete certainly makes a lot of sense. But if you leave a regulatory void like China did, you could end up, as you correctly pointed out, with a duopoly where Alipay and WeChat Pay dominate the payment systems, make it very difficult for new entrants to join the payment space. And of course, as the Chinese government has become very concerned, they control vast amounts of data and are not under clear regulation about how the data are collected and how they are used. There is an intermediate way that I think might prove to be a solution to these different tensions, and that is the India stack approach. What India is doing, I think, is very sensible in terms of providing the payments infrastructure, the unified payments infrastructure, which is basically a government-run payment system that acts as the back end on top of which private payment providers can innovate. So even though you may have a lot of fragmentation in terms of the payment providers, you do have the interoperability assured by the fact that the government is providing the back-end payment services. So now you have a level playing field where, in fact, existing payment providers as well as new payment providers will have easy access to this payment system and can make sure that the different payment systems talk to each other. So you have competition and you have the private sector basically doing all the payments innovation at the front end, but at the back end, you have the government providing the right kind of infrastructure. But there is a very important additional set of rails that the government has provided that are important in terms of these broader objectives. The first, of course, is the identity rail through the biometric identification scheme, which has given practically every person in India easy access to a digital form of identity, whether you're in a rural area, whether you're illiterate, and so on. And that biometric identification is really important, and it's also created the architecture or the infrastructure to be able to conduct certain government policies, such as cash transfers rather than subsidies of various sorts. That is, quite distortionary. So the cash transfers can now be linked to bank accounts that in turn are linked to those with those biometric identities. But the other part that is equally important is the government is setting up data aggregators. Now, the legislation is not through yet, but the idea is that these data aggregators would basically suck up the data that are collected by different payment platforms, and they would be the ones under the government's regulation who let the owners of the data, which is, of course, the consumers themselves, decide what is done with the data, who gets to see the data, and what sort of regulations control the use of that data. And that is going to be a very important consideration for all of our economies, because ultimately one thing that is coming out of the new financial ecosystem as it moves towards a more digital form in all aspects is going to be a lot more data that is available. And making sure that this data are really in the hands of the consumers in terms of how they are used is going to be really crucial. So I think the tensions you pointed out are ones that every country is going to have to deal with. But I think there are ways to find a middle path that allows you to create the ground for private sector innovation without the government being too intrusive, except in areas where it really needs to exert a somewhat heavier hand and not leave things to the private sector.
I agree with you. That is, I think that the India experience is very smart, and they are clearly pointed out these three rails that you mentioned: the one on payments, the other one with digital identity, and the other one with data. But I think that in other jurisdictions, we are beginning to see a very similar approach. That is, you take, from my perspective in Europe, in some sense, the CBDC discussion is looking to play this role of the payment rails that you mentioned. And this is also together with all this discussion on the open data space, all this discussion on the digital identity in Europe. That is, you think of it in some sense, in several jurisdictions, things are emerging in this way. That this is not only the proposition from the CBDC that we are going to enter now in the discussion, but it's also these other things that complement the system. That my point on that, and I think that is very close to your discussion, is that it's not only the CBDC the answer to what is happening, because this is a global phenomena that reaches several aspects. Some of them are purely in the financial system, but some other, like data or digital identity, are outside the financial system. Then in some sense, the financial regulators should talk with the other authorities also. Then do you see that this kind of coordination is becoming increasingly important, and that the authorities is taking this into account?
It's important. Whether it's happening is not entirely obvious, because regulators do tend to be quite siloed in many countries, and I think regulators are trying to deal with an important issue, which is whether they should tweak existing regulations to encompass the new products and technologies, or think about rewriting regulations in a way that makes them much more expansive and, in a way, much more flexible, in a way that they can be adapted to new technologies. But you're right, Jose Manuel, many of these conversations are not just about economic or technocratic issues. We're going to have these discussions at the societal level. If you think about CBDCs and how they might eventually displace cash, giving us no access to an anonymous method of payment anymore. We don't need to talk about this is a societal level, whether we're comfortable moving to a world where we completely lack access to an anonymous means of payment, and every transaction, like me buying you a cup of coffee, is going to be visible either to a digital payments provider in the private sector or to a central bank in the form of a CBDC account.
Yeah, let me go now to the CBDC. But before jumping to the CBDC, I know that I should ask you one question, and is regarding the El Salvador experience. My question is going to be based on what that is. I understand that part of the justification of recognizing the legal tender status of Bitcoin in El Salvador has been related with what you mentioned, that is the cost of remittances, the cost of cross-border payments. But my question is, why do you think the authorities use Bitcoin as the legal tender proposal, and not use other alternatives like some stable coins that will have less volatility and also will be easier to with these proposals to manage issues like AML or CFT and requirements? That is, why do you think this country is choosing specifically Bitcoin and not these other crypto alternatives, more stable and more safety?
So our colleagues at FLAR know El Salvador much better than I do, but looking at it from the outside, it certainly seems a desperate measure by a desperate government to make up for its failings. Ecuador has been a dollarized economy for a long time, and that certainly is not politically convenient for Ecuador's leaders because it puts a lot of constraints on their policies, and Ecuador certainly has a lot of issues with fiscal mismanagement as well. So I think the notion of using something like Bitcoin to fix a lot of Ecuador's fundamental problems in terms of easy access to the international financial system, getting around US financial sanctions, and perhaps even riding the Bitcoin wave, buying a lot of Bitcoin and maybe easing up the government finances if the value of Bitcoin were to rise very sharply. I think those are all attractive ideas for a government like El Salvador, but frankly, I don't think this is the path to successful outcomes in any of these areas. As we've been discussing, Bitcoin, even if you think about the particular form in which they're using it in El Salvador, which is not literally Bitcoin, but a version of a token related to Bitcoin, that's not going to be very efficient as a payment mechanism, especially at the retail level. And I don't think it's going to accomplish these broader objectives that the El Salvador government really wants. So I think El Salvador should really focus on getting its house in order in terms of its domestic policies before resorting to a measure like this.
Absolutely, I agree with you. Yeah, just Jan, because we have like 20 minutes and we are going to run short of time. Jan, to the CBDC, that is one of the hot topics on this payment discussion. I'm going to take the privilege of being the moderator, the one that asks, and I'm going to translate you the typical question that I always have to face in most of the forums, and is that is at least in the developed economies, at least we already have a very efficient payment. We have a lot of things. We can do most of our transactions are not very expensive, at least the domestic one. Then why you think we need a CBDC? What we could have with a CBDC that is not possible to do today?
So actually, just before this session, Jose Manuel, I was giving evidence before a House of Lords Economic Affairs Committee, and this was certainly the key question at hand.
Yeah.
Unlike in the US and Canada, where the private payment systems are still quite inefficient and costly, so interchange fees on credit card payments, for instance, can range up to 5%. Britain has a fairly efficient digital payment system. So as one looks around the world for CBDCs, there seem to be a few motivations at play. One motivation in countries where there isn't easy access to a digital payment system or broad financial inclusion, a CBDC can provide a path to financial inclusion. The Bahamas, which has just introduced the first nationwide CBDC, the sand dollar, views this as a primary objective, and many other developing countries do. In a country like Sweden, where the private sector provides digital payments very effectively, the idea is to provide a backstop to the private payments infrastructure. In other words, the private sector does its job very well, but in a time of technological or financial confidence vulnerability, you want to have the central bank providing an alternative payment system that is always there for everybody to use, even if the confidence in the private sector payment system fails. And third, you can think about, as in the case of China, a CBDC, as basically providing a platform on which new payment providers can innovate. So the Chinese CBDC, the digital yuan, is essentially meant to keep central bank money relevant at the retail level. Now, we can argue about whether that is a worthwhile objective or not, but certainly the People's Bank of China seems to view it as important in making sure that the entire payment space is not dominated by the two payment providers. But this is going to be a case-by-case issue, country by country, to think about what objectives a CBDC can really fulfill. And in a country like China and or India, one might argue that the user case is actually much weaker than in many other developing countries. So it's really going to be a case-by-case, country-by-country analysis.
I agree with you that yes, the arguments behind each countries could be very different, but in some sense, the experience of China shows us that it is very important to be prepared in the case of big tech, of other companies develop alternative payment system. What you point is very important, that is to be able to have a platform of interoperability between the payment system. And in some sense, this is a good lesson for most of the countries that basically are working on the CBDC in order to be prepared in case stable coins or other proposals will be developed and to be able to be useful as an interoperability link between several payment systems. Let me put on the table other typical question, and it's the one related with, I have from the audience several questions on that, and this is related about the implications for financial stability. As you know, that is CBDC is basically a liability from the central bank this could imply some changes in the funding of the banks and some changes also in the connection in the reliance of the banks with the customers. Then what implications could have this for the financial stability, for the business model of the banks? Should this be a concern of how to introduce the CBDC? What will be the implications for the credit availability?
That's a crucial set of questions, and it's certainly one of the risks of a CBDC, especially if a CBDC takes a form of a digital wallet that is a central bank account. You face potential risks of disintermediation of the banking system because you might think about a central bank account as being safer than a commercial bank account, even if there is a deposit insurance system in place. And then especially in a time of financial panic, you might have a wholesale flight of deposits from the banking system into the central bank digital currency accounts. And that could precipitate the very financial instability that you're trying to avoid. I think there are ways that you can design a CBDC to fix some of these problems. The Bahamas, which I referred to earlier, provides a very simple answer to the question of how do you prevent flight of deposits or complete disintermediation of the banking system, which is that you put a cap on the amount of balances that can be held by consumers or businesses. The balance is slightly higher for businesses in CBDC accounts. The existing or the evolving design that we're beginning to see in countries like China and Sweden, which are undertaking CBDC experiments, also points to a way forward to keeping commercial banks relevant. So in these countries, we are moving towards a dual layer architecture where essentially the central bank provides its liability in the form of what are essentially digital tokens, but the digital wallets are actually maintained by the commercial banks. So these would be non-interest bearing CBDC digital wallets in parallel with their deposit bearing interest accounts. So in this case, the commercial banks and other payment providers can use the CBDC to innovate in terms of payments, as we were discussing earlier, but the commercial banks remain important in terms of maintaining know your customer requirements and so on. So I think there are ways in which some of the risks of disintermediation of commercial banks can be maintained, because nobody, I think, including you central bankers yourself, really want to be in the position of taking a large amount of deposits from the public and having to be in the position of allocating credit in the economy. And certainly, given that in most modern economies, commercial banks create most money as we know it. If you think about an aggregate like M2 rather than central bank money, we certainly don't want to do anything to affect commercial banks in such a drastic way. But having said that, commercial banks do face very significant threats to their business models from new technologies, from new fintech lending platforms, and so on. So changes coming on that front. But I think the CBDC risk to the banking system can be mitigated.
Yeah, I agree with you. That I think that there is a consensus on these two layers scheme. That is that you have to rely on the private sector in order to distribute these wallets. This is something that, from my perspective, is clear. But where this is not so clear is who should be the one that distributes this wallet. That is because at least in the Europe debate, we clearly identified that this should be regulated entities. That is something almost clear in every jurisdiction. But these regulated institutions could include the banking system, obviously, but also, for example, electronic money providers. That some of the big techs already have this license of electronic money providers. Then it's not clear who is going to be the distributor, and this the customer relations will enter more competition from this big tech. With the CBDC, just two issues that you touched on your book that are very interesting. The first one is related with this the implication for cross-border dollarization that you mentioned, that one of the risks of the CBDC that will become easier for individuals to choose which currency they will prefer to use. And this could create, for some small countries, the risk of dollarization or euroization. And in some sense, this for me, this is a bit counterintuitive, because with the CBDC, it will also, for example, to implement capital control, because it's something that you can program it in the CBDC and avoid, for example, that this could not be spent in other jurisdictions. But taking into account this one, do you see any role of organizations like the IMF in order to have a more proactive role to coordinate all these initiatives in order to avoid sudden change in the currency management?
It's going to become a big issue. I mean, if you can even think about, basic payment systems as potentially posing risks to financial regulation, you could very well envision a situation where the entire retail payments infrastructure in a country is managed by a payment provider who sits outside your regulatory jurisdiction. Because again, if you're using stable coins provided by international stablecoin providers, or even digital payments provided by, say, Alipay or WeChat Pay, you could have access to these sitting in basically any country, and it's very easy to access those digital payment systems. And adding on top of that, the easy availability of CBDCs across borders creates another level of issues. Now, at one level, there are certainly many benefits to having more conduits to international payments. Certainly, it's going to bring down costs. It's going to make things much quicker. It's going to make it easier to track payments in real time. This is going to be good for cross-border trade. It's going to be good for economic migrants sending remittances back to their home countries. But all of these also mean that you're going to have many more conduits for capital to flow across national borders, which is going to make it much harder for countries that are trying to manage capital flows, manage exchange rates, and of course, emerging market economies and developing economies more broadly that are very affected already by capital flow volatility and the associated exchange rate volatility are going to face even more of a challenge. And I think there is going to be an existential challenge that many countries face, both in terms of their currencies as well as their central banks. And this is true for many small economies, many developing countries that do not have credible currencies or credible central banks. One can very well see digital versions of the dollar or perhaps even the renminbi, if it was widely available outside those countries, or even a stable coin provided by a company like Facebook being much more trusted than domestic currency. So I think there is going to be at least some reordering of the second and third tier currencies, which are going to face fairly perilous circumstances as these technological innovations take hold.
Yeah, absolutely. A very challenging situation for these countries. The second question, I think that this could be the last question, is related with the central bank mandate. That is, you highlight in your book how the financial crisis imply that the Greek financial crisis implied that the central bank mandates should change and put at the same level as price stability, the financial stability, take into account that their tools is not only the interest rate for monetary policy, but also they have tools on regulatory side. Now, with all these things that is happening, many other issues are rising, like promoting safety innovation, keeping a level playing field, but also with the CBDC, you open interesting question. Like, for example, on one side, is possible to control or monitor or knowing more about what the people are doing with the payments. Then there are some things related with privacy that are clearly out of the scope of the central banks. At the same time, you are able to issue a spirit day, or you are issue conditional money that maybe are decisions that are outside of the central bank. But at the same time, if you take all these functionalities, you are also you could also damage the credibility of the currency that is clearly inside of the central bank. Then I don't know, how do you see in this framework the situation of the mandate of the central bank? But in some sense, should we make a deep revision of what should be our role in the future? Because there are many issues. We are taking decisions. We are analyzing many issues that are clearly out of our scope, but is very linked to some of our primary roles, like keeping the stability and the trust on the currency.
That's a very profound question, Jose Manuel, and it's going to be a tough one for central banks, governments, and societies to consider. CBDCs, provide a wide range of functionality. You can undertake helicopter drops of money into central bank accounts, which would be good at a very difficult time for an economy. And we've certainly seen a lot of perilous times in the last decade and a half. You could have, units of money being issued with expiry dates in order to stimulate consumption or investment. One of the benefits of a CBDC is you would pull a lot of economic activity out of the shadows and into the tax net. But you can very well see the government then beginning to use the central bank as an agent for many of the activities that a government actually should be conducting directly. And this could end up creating a very difficult circumstance for central banks, because ultimately what is crucial for central bankers such as yourself is the legitimacy and credibility you have because you are seen as independent institutions. If you get too tangled up with government policies, I worry that the core credibility and legitimacy and therefore the effectiveness of central banks could be compromised. And that is a real concern, even though CBDCs may be wonderful in many other policy-related ways.
Yeah, one final question or one final thinking on that. I clearly agree with you that is part of our legitimacy is if we are closely linked to our mandate. And even that you have, okay, maybe this thing could be good for the society. And for example, with all this thing related with the green finance, there has been some people claiming, okay, you should do some green QA because this will help the economy as a whole, but this is not in my mandate. And if I will jump my mandate, it's very difficult for me to have credibility and be trusted. Then this is critical for our reaction. But I found that in this discussion on, I would like to know your opinion on that. In this discussion on financial innovation and what is happening to the financial system, many times we focus on the transition, on how this is going to evolve. But I found very little discussion on what will be our desirable financial system in the steady state, and what will be the final design of the financial system. And in this sense, and this is maybe not in our mandate, but it's something that we should think about, what will be the financial system that will be better in order to provide not only efficiency, but also things that are becoming more and more important, like economic inequality, avoiding gender or race bias, or providing a sustainable funding for the economy. Then I don't know, how do you see this debate, this more long-term debate of what will be the roots of the financial system?
That's, again, a crucial set of questions that every society will have to ponder. The one conclusion I came to in the writing of this book is that while technology is going to have many benefits in terms of broadening access to financial products and services, it's going to be able to increase the reach of low-cost digital payments and so on. There is a risk, in fact, that you could have existing inequalities in societies being exacerbated, because right now digital access and financial literacy are very unequally distributed. Yeah. So all these wonderful innovations might end up worsening those inequalities. And the other thing is that technology is not going to solve all problems. Even in the narrow context of DeFi, I think governments will have to play a role in terms of providing the right sort of guardrails so that the benefit-risk trade-off remains a positive one. So I don't think leaving it to technology and the private sector is going to solve all problems and could create even more new ones. So I think governments are going to have to play a crucial role in making sure that this trade-off comes out the right way, not just for a small fraction of the society, but for society more broadly.
Thanks a lot, Eswar. It has been really a pleasure. I only can recommend everyone reading your book. It's really an absolutely amazing book in order to not only knowing how the financial system is working, how it's been transforming, and how it could be impacted by all these things that are happening with the new technologies and the financial innovation, but also to think about these more profound issues, that where we are going and what are the main trade-offs that we are facing. That something is not on the table on the governments. And I think that there should be more discussion between authorities, government, financial regulators, private sector. That is one. I think one of the big implications is that cooperation, international cooperation, national cooperation should increase, and we should think in these long-term issues. And your book is one of the most absolutely best works to think about it. And I will give back the floor to Antonio, and just thank you for all your thoughts and for writing this wonderful book.
Thank you, Jose Manuel, for guiding the discussion. It was really enjoyable. And I also thank Jose Dario Uribe and his colleagues at FLAR for all the wonderful work they're doing on these issues in the context of Latin America, and to all of you who joined this discussion.
Thank you very much, Jose Manuel and Professor Prasad, for sharing your knowledge with all of us. To our audience, don't forget to register under the chat. You will find, you can click, and you have the opportunity to win a copy of Professor Prasad's latest book. And to all of our audience, remind that on Thursday we will have our final open session that will be held by the BIS Innovation Hub. The head of the BIS Innovation Hub, Benoit Courret, will be talking with our General Secretary, Fidel Jaramillo. Until then, stay safe. Bye-bye, and thank you.